Hi, everyone, and welcome back to Nolan Navigates. I'm Beth Nolan, private wealth advisor for Raymond James. Today's conversation is one I've been looking forward to because we're talking about something that touches almost every major decision people make, but rarely gets talked about beyond the surface. Insurance. And before anyone thinks, oh, this will be dry, I want to promise you this is a really great conversation about people, families, businesses, and what happens when life doesn't go according to plan. I'm joined today by my friend Amanda Martinez, an advisor with BCU Risk Advisors who works extensively with ultra high net worth individuals and families on risk management and insurance strategy. Amanda, welcome.
Thanks for having me.
Yeah. Let's start with you. People don't always grow up saying, I want to go into risk management or insurance. How did you find your way into this work?
Yeah. People also don't say I want to be an actuary, and that's where I was headed. So I went to Lake Forest College, which is on the North Shore of Chicago. It's a small liberal arts school. And growing up, I had loved math. And so I knew I wanted to be a math major. I didn't know what I was going to do with that because I also knew I didn't want to be a teacher. Teachers work so hard, too hard. And they are just not appreciated enough. Both my parents were teachers and I watched them as I was growing up. And so being a math major, it was like, well, what do I pair with that? And what do I do with this? And so I decided to add a business major onto that. And I wanted to be an actuary. And in the actuarial world, because there's a series of exams, the best way to go about that is to get an internship at one of the large insurance companies. And so there's an insurance company downstate Illinois, and they have a great internship program. So I had my sights set on that. So after my sophomore year of college, I decided, hey, I'm going to get there. And the way that I'm going to do it is I'm going to network. So I started calling the agents in the area where I lived and basically just said, I'll do anything. I'll pick up coffee for you. I'll scan papers, whatever you need. And one of the agents that I had reached out to was like, actually, we're hiring someone for the summer. We want someone to cold call. And I was like, yeah, sure, I can do that. I just cold called you, which are all the first signs that I was never going to be an actuary. And
For sure.
And so from there, it kind of just exploded. And I stayed on this side of the business because I love working with people. We can navigate the numbers and the risk and all of that. But at the end of the day, it's the stories and it's what that one-on-one relationship to make everything work for a family.
Well, great. That's great. Okay. So was there a moment when you realized the ultra high net worth space was really where you wanted to spend your time? And why was that?
Yeah, it's funny because I kind of also fell into that. So after I had graduated from college, I was moving to Texas and was just trying to stay with that same insurance company. And no one was hiring at that time for that company. And so I had a recruiter reach out, which is, often happens in the brokerage space and insurance. And they said, hey, we're looking for someone to come in, work with these high net worth clients. And I had no idea what that meant, but I needed a job because I wanted to move. And so I went on the interview. I could tell at the time that the partners were like a little bit hesitant. They were like, you don't really know this space, but we're going to give you a chance. And I learned so quickly that the more complex things are for clients, the more I get to use my brain and the more that I enjoy it. And you get to be creative in those spaces. You get to negotiate. And so, once I had a taste of it, I was never leaving. There's a whole commercial side of the business. And I just love this so much more.
That's great. From the outside, people assume that wealth sometimes simplifies problems. But in your experience, what makes ultra high net worth risk more complex?
Yeah. So people, I think, have this vision of property and casualty insurance, and they're like, I have a home, I buy home insurance. I have a car, I buy auto insurance. And that's kind of where it ends. And the reason for that is I think a lot of times you see a mortgagee require insurance on your home, or the state requires insurance on your auto, but no one's requiring insurance on the things that there is no kind of maximum loss on. So you get into an auto accident and there's this liability exposure. If it's your fault, you owe the other party to repair their damages. And I think what we find is that people don't often think about that because they've checked the boxes that they need to. And so what I love about my role is that I get to have those holistic conversations. I get to then start talking about a self-insurance philosophy, paired with making sure that the things that really matter, that we can continue our lifestyle if something like that happens, are in place.
Yeah, that's great. That's great. And you've likely seen when someone has a major liquidity event, maybe they sell a business or they're an executive and there's a public stock sale, their financial profile changes overnight. And a lot of times that profile becomes very public. So, and in some cases, they become a target. How should those individuals be thinking differently about insurance and risk the moment that happens or leading up to that moment? Because it's not just about protecting assets anymore. It's about personal exposure and making sure that their coverage has kept pace with their new reality.
Absolutely. Absolutely. So I would say definitely leading up to that, we love to have the conversations of this is going to happen, because typically when they get that liquidity event, they are thinking about how they're going to live the rest of their lives. And that might mean they're going to buy a home in a place that they've always enjoyed visiting. It also might mean they're going to buy a yacht, and hire a captain and crew to run that. And so being able to navigate some of those conversations in advance of the sale really gets the client set up for success. We can start to think about the insurance companies that would be a good fit for some of those risks that they're considering. And then once the liquidity event happens, the liability conversation is so important. At that point, the nest egg is so much bigger than it was previously. And to your point, a lot of this information can be found online. And it does put a target on their back. So we go back to the auto accident, and you get into an auto accident, you're handing your ID card to someone that you've never met, right? And they can see your name, they can Google you, they can see what car you're driving, they can see your address. And not that that is going to create a larger verdict, but it could. It could. It puts a target on your back. And I think in some cases when that happens, people want to go harder because there's a distrust of high net worth individuals and large corporations and that type of thing. So we've really been seeing those nuclear verdicts spike. And then the other thing I would say leading up to the liquidity event is every client should have some personal cyber insurance. You have been protected by your business and that IT department and the cybersecurity for so long. And now that is gone. Maybe you're buying your first personal cell phone. You've got your first personal computer. That makes you a target again. The cyber criminals can find you online. And what they're looking to do is they're looking to intercept any transactions that are coming through. They'll see invoices going back and forth. They'll see conversations that are happening as a part of that transaction. And it might be personal, it might be business, but it's probably a combination of both. And having that personal cyber insurance allows you to have a response plan on the personal side if you were attacked.
You've taught me a lot about this space of cyber insurance, but one of the things that really stuck to me is how much of our home is hooked up to our internet.
Yes.
And a lot of times we have people in and out of our homes. Maybe it's people who are working for us, or even if it's just a temporary visitor who gets on our Wi-Fi, and now all of a sudden is their phone now attached to us that someone could swipe information off of? And so even if it's, the most, well-intended person, it doesn't necessarily mean that, it's not just you that could fall victim to this. Your web becomes much greater.
Yeah. And the other thing to think about there is all of those smart devices. So my husband and I built our home a couple of years ago. And the one thing that I thought was going to just revolutionize my life was that my blinds open and close by themselves. They're connected to the internet. And all of those devices that are connected to the internet, it might be a thermostat, it might be anything, they all have patches that are coming through because there's a vulnerability that's been detected by that maker of whatever the device is. How often are we updating those? Not very often. We're not letting that do that automatically. On our smartphones, that comes through as a notification. And so we have to keep clearing it or you update it, right? But we're not doing that often on the Nest thermostats or any other routers, those type of devices. And that leaves everyone vulnerable because cyber criminal only has to get into one to make a profit.
Yeah, we could talk about this all day for sure. So this is where I think our work intersects so naturally. Insurance isn't just about replacing assets, it's about protecting what you've built. And so from your perspective, what challenges come up when insurance planning and broader wealth strategy are not aligned?
Yeah, so I think one of the things we hear often is clients come to us and they're like, I finally did my estate planning, right? And we're so excited for them to finally get through that process. And I know that sometimes it takes longer than it should because we have to start thinking about what happens when we die, right? And I think what we find is a lot of clients, when they're doing that, they're thinking about asset protection. Also, are we setting up some type of trust? And is our home then titled in a trust? Or do we have any type of additional homes that might be owned in LLC or vehicles that are owned in LLC? And as part of that conversation, if those vehicles, those homes are titled in those entities, we have to add them so that they have not only liability coverage, but also property coverage. Because what the insurance company is looking for when they're paying out is that the name that's on the insurance policy matches the title. Otherwise, there's no insurable interest. And so they don't have a duty to defend, and they don't have a duty to pay out on claims. So that's really the most important part. And that's the part that we find probably 75% of the time when clients come to us and they're so proud that they've done this estate planning, that's the part that's missing.
Interesting.
Mhm.
That's great. On the flip side, when advisors collaborate, legal, financial, insurance, how does that elevate the client outcome?
It makes it so great. It's so wonderful when we have situations where an advisor can hear something. They hear that a client's looking for a new home and they can notify the insurance broker early on. So we can start to plan for that. Or if they've done that estate planning or they're thinking about doing that, we can then make sure that we're following up on it. And then in addition to that, we're thinking about those liquidity events. Again, we can continue to have those conversations, and it just makes for a better client experience because they don't have to start thinking about what they should know about insurance. We can all respond to the information that we have together as a team.
Yeah, proactively. That's great. Let's talk about how often you should be reviewing your policies. I'm thinking in particular about homeowners insurance, which, especially if you live in high risk regions like Florida, California, can shift in both coverage and cost very quickly.
Yes.
So, for a client who hasn't reviewed their policies in a while, how should they be thinking about this?
Yeah, really on an annual basis, they should be at least looking at their policies. As a broker approach, we should all be looking at them as well. Being a broker, we know what's happening in the industry right now. There's things in Florida that are taking place that we haven't seen in a long time. And I'm talking about rate decreases, which is absolutely wild, but it gives opportunity for those clients that are living there. And yes, some of this has hit the news cycles. And so, many of the consumers in Florida might be aware of some of these type of things. But, I think just considering what's happening each year, historically we've said, okay, well, if you have an 8 or 10% rate increase, that's unusual. In the last 6 or so years, it's been more like a 20% rate increase. That's normal. And we're kind of coming down from that at this point. And so I would say you should be hearing from a broker. You should be hearing from your agent on an annual basis just to check in. And really as a client, you should be looking at your policies every year just to make sure, again, if you see something on there that doesn't look right, maybe there's a home that you're still paying for insurance on that you've sold. Those type of things are impactful and, can save premium and save real heartache when there's a claim.
Okay, so my favorite thing to do is rapid fire questions. So, what's the biggest misconception about being fully insured?
You'll never be fully insured.
Good answer. What do insurance gaps, where do they most often show up?
Liability and the estate planning.
Okay, very good. So, in your opinion, when does risk accelerate the most?
At that liquidity event.
Okay. Would you also say in this day and age, especially related to the cyber security, is it as you age, are older people more vulnerable to the cyber attacks and the cybersecurity and have a need for more insurance in that space?
Yes. Over 60, we see more attacks and definitely more losses.
Okay, very good. So as we wrap up, for listeners who are business owners or families with growing complexity, what's one mindset shift you'd encourage?
I would encourage people to think about their insurance not as a maintenance plan, more as risk financing. And so when we start to think about it like that, we decide what we need to finance and what we don't. And it might be less of the financing on your homeowner's policy and more of the financing on your liability risk. And I think when we start to take that shift off of, using it as a maintenance plan where, oh, well, there's some roof damage, I need a full new roof, and really start thinking about it as a large catastrophic claim, you're going to get more out of your insurance. And you can also use those premium dollars that you're allocating to your insurance more favorably.
And I'd like to add, make sure your advisors are talking to each other. integration isn't a luxury, it's a necessity, especially in this ultra high net worth space. Amanda, thank you so much for such a thoughtful conversation. It's great having you.
Yes,
Yeah.
thanks for having me.
All right.